More layoffs are coming. I'm your host, Steve Van Metre, and thanks for joining me today. And our lead story today, just when workers thought they were safe, major corporations just announced another round of big layoffs is coming. And we're going to talk about what industry I think is coming after that, and it will shock you. Plus, we're going to talk about the Federal Reserve and how they want to see the labor market cool off. But at what point will they say enough is enough? And last, what are the experts are saying that is driving the market higher? Well, we're going to take a look at why it's on fire and why it's likely not to stop anytime soon. Let's over to Bloomberg, where we picked today's story up with a headline. U.S. employers announced more than 100,000 job cuts in January, as the number of planned reductions is now more than twice the December level. And this is really a shock here because a lot of people thought that all these layoffs were going to start to end here early in the year. They kind of expected that, hey, there's been a whole bunch of them. We've trimmed our company down a bit, and now all of a sudden maybe we can just be, in the middle of the storm here, in the eye of the storm, and perhaps if the economy turns around, the storm will dissipate and we'll get through this. But right now it looks like corporations are saying, no, we've got more to go. Businesses reported 102,943 cuts in the month, more than twice those announced in December, and up 440% from January 2022. The tech sector made up 41% of the planned reductions. Announced layoffs at retailers and financial companies also climbed for a year ago. And the key thing here is these announcements mean companies are saying, hey, we're going to lay these people off. There are rules and regulations they have to follow here. And it doesn't mean that workers actually know yet. And that's what's shocking. They might be just hearing, hey, our company is going to start laying people off. They don't know if they're affected yet. All they know is their company is saying the axe is coming. We're now on the other side of the hiring frenzy of the pandemic, and what we see is companies are preparing for an economic slowdown, cutting workers and slowing hiring. And so this is another issue here we start to understand of what the dynamic is going on, is when people believe the economy is going to slow down, they start to cut back their spending. And what are companies going to do? If they agree as well the economy is going to slow down, well, they're going to cut employees. They're going to slow the rate of hiring. They're going to cut back their expenditures. And next thing you know, you have a self-reinforcing feedback loop where the economy does slow down and in a recession because everybody believed it and they acted on it. And that's what we're seeing now is happening again. While economy-wide layoffs remain generally low, more and more companies have announced job cuts in recent months. The layoffs have been particularly acute in the tech sector, where companies like PayPal, Alphabet, and Amazon all have announced plans to dismiss thousands of workers. The good news, perhaps, here is the reason we're not entirely seeing this in the labor market yet in terms of the unemployment statistics is a lot of these people are getting severance packages, and some of them are getting absorbed in the workforce, as we'll see here in a little bit. But let's talk about what's going on with the Federal Reserve now, because we heard yesterday they want to see the labor market continue to cool off. And why is that? Is they're afraid of something called a wage price spiral, where companies are forced to increase wages, and then in turn that means employees have and consumers have more money to spend, and that drives inflation. But of course, it doesn't make a whole lot of sense if you do give some employees wages, but you cut off other people and send them on the unemployment line. Well, those people that lost their jobs, their spending power is going to drop significantly. The U.S. labor market is seeing cooling, but not nearly enough for the Fed, as tomorrow we'll look for the payroll report that's estimated to be around 190,000 jobs created, still well more than the Fed wants. But at what point when they say is enough? Fed policymakers on Wednesday slowed the pace of interest rate increases and also indicated further tightening is in store. And of course, we note that the Fed is not happy that financial conditions are easing. Of course, if you're wondering what the best barometer of financial conditions is, that's the stock market. If it's going up, I believe that financial conditions are easing. If it's going down, that means financial conditions are tightening. Now, of course, you can already guess what direction the Fed wants it to go, because if the market comes down, that means people spend less. But do they want it to go down? Well, maybe not necessarily that much. I continue to think there's a path to getting inflation back down to 2% without a really significant economic decline or a significant increase in unemployment, said Fed Chair Jay Powell. And this is a big issue here because what the Fed wants to see is the pace of hiring cool off. They want to see those wage increases that many people absolutely need because of inflation. They want to see them moderate and come down. That's what they want to see, but they don't want to see the labor market turn and go down the other direction and see layoffs accelerate. So now let's flip over to this chart here. And what we're going to look at is the total non-farm payroll report. We're going to show this on a year-over-year rate of change against the federal funds rate. And what we can note is that it seems the Fed doesn't have a lot of power here in terms of what they think their control over the labor market is, because you can note there's periods where they raise rates, but the labor market holds fairly steady here and then just starts to decline. We can go back here into 1994, and what do we notice? The Fed aggressively raised rates, and the labor market continued to grow and then cooled off a little bit. In fact, we can see in every instance, the Fed raises rates and the labor market just slows a little bit. It's not much. But what happens after those rate hikes is that then you start to see a trend where the labor market really starts to cool off and the Fed chases it to the downside. So what we see in the initial reaction here is the Fed doesn't have much power over the labor market, at least not as much as they think. And that's really important here, because right now what we're wondering, the question we need to ask is, will consumer demand come back? If it comes back, we engineer the soft landing. The Fed looks like heroes. If they don't, well, then the worst is yet to come, as we will soon see. And now we can look at the 4-week moving average of initial claims. And again, we can look at the labor market in multiple ways, and we can see that peaks in the federal funds rate actually coincide fairly closely with lows in initial claims. It's not until after that that we see claims start to steadily rise as the economy slows. The question I'll leave you with the answer to: is it the Fed that causes the economy to slow, or is it just other effects that are happening here? Because right now, when we look at the labor market, as we get into the initial claims data that we just got yesterday, what we can see is people are losing their jobs, but they're getting new ones. And we're seeing people that are on the unemployment line are actually getting jobs as well, suggesting that perhaps the labor market is far stronger than the Fed wants it to be. Here you can see initial claims down 3,000 to 183,000 as of January 28th. This is just an impressively low number. Remember, when you're in the low 200,000s, that's a strong labor market. This is showing that employers, at least broadly speaking, are hanging on to employees, perhaps not the big tech companies. And how about this? Continuing claims at 1.655 million, down 11,000. And so again, we make the case here that the labor market at least appears to be rather robust. The question is, do people believe that we're headed into a recession? If they believe it, they'll cut their spending, and it will become, as we said, as one of my former high school teachers said, a self-licking ice cream cone, and this will be a tidal wave of a downturn to the rest of the economy. Of course, we won't see that now for months to come, because what we know right now is employers want to hang on to these employees. The question will be, for how long? But one thing that has changed is, well, we could see the machine positioning, as I showed you on the CTA Timer Pro report, driving the market higher. This report giving you a good leading indicator of how the machines are positioned. Watch out today. Watch to see that at some point the fast algorithms flip back to 100% long. I imagine that will come in a couple days. But one thing that did change is the price did go up to $30. I did say that. I know some of you have emailed me, say, wait, I'm not ready. I'm just about to buy. So here's the deal. I'll put a link in the description. There's a coupon code for 50 more seats. There's a $10 off. This will get your price down to $20. If you want to check it out, it still has a 30-day money-back guarantee, so you can do that. But now let's talk about where the layoffs are going to come the next round. That's going to be the financial sector. As mortgage demand took a big step back last week, even after interest rates fell further, this is a sign the economy indeed is slowing. Even with rates well off their recent highs, applications to refinance a home loan fell 7% for the week and were 80% lower than the same week 1 year ago. Homeowners may have jumped back briefly after the holiday lull, causing demand to rise much over January, but still there are very few borrowers who can benefit from a refinance at today's rates, and that is a key part of the mortgage industry. The reason you see demand for refinancing is because rates go down and people refinance as rates fall. They tend not to refinance at higher rates unless they need to extract equity from their home. Mortgage applications to buy fell a whopping 10% for the week, and we're down 41% lower year over year. While both home prices and mortgage rates are coming down steadily, the supply of homes for sale remains quite low, and that may be keeping mortgage demand under pressure. But purchase activity for those of you who are looking to sell is expected to pick up as the spring home buying season gets underway. Perhaps this will bring some buyers back even at higher interest rates, and perhaps the one thing that will give them some confidence is the market's now heading higher. Of course, we know the U.S. economy follows the market, so this is a good sign. In fact, it even tells us that perhaps the Fed could possibly engineer their soft landing here. That may be the reason we heard Fed Chair Powell not worry too much about financial conditions easing, is because he already knows where the economy is going, and if the stock market can lead it out, well, he'll look like a big hero. Stock, bond, and crypto investors bet the Fed is bluffing on interest rate hikes, and it's really the bond market that has a story here, as many investors are skeptical that the Fed will keep interest rates higher for longer, despite the central bank's outlook that it is unlikely to cut rates this year. Of course, the markets are calling their bluff, and it's not the markets, it's the yield curve that we've talked about for so long here. Here we have the 10-year 3-month yield curve in blue against the federal funds rate, saying that, hey, when we're inverted, as we are right now under the black line, the probabilities that the Fed is going to pause, or in the near term and even in the long term, are extremely high. So it's not that the market's betting on it, it's the bond market has already said this is the likely outcome. This is probably the last hike now, and we'll see for this cycle. And the bet is the Fed goes to pause mode. Of course, the market loves it because they think that when the Fed stops raising rates, liquidity comes back to the market and stocks rally. That's the prevailing view, or it could be that people are just going to buy because the Fed's going to pause. Fed Chair Jerome Powell didn't try to push back against market expectations of a shallower rate path during Wednesday's press conference, and instead chalked up to the divergence to a difference in perspective on how fast inflation will come down. He says, I'm not going to try to persuade people to have a different forecast, but our forecast is that will take some time and some patience, and that we'll need to keep rates higher for longer. I'm going to give you a different view that he knows inflation is going to come down really quickly. He wants the market to rally here because then he can cut a little bit into that rally and see the economy kind of surge back. So that way he can engineer his soft landing, bring inflation down, and let the market lead the way. Here's the answer. Well, let's head over to this chart. The CPI index against U.S. regular all formations gas prices say that the probabilities the CPI will get down to 2.5% is extremely high, and that will be close enough to give Fed Chair Powell the room to cut. If the stock market leads the economy higher, well, indeed, that means the soft landing now becomes a potential case. As a measure of financial conditions from the Federal Reserve Bank of Chicago has continued to fall since October, declining readings indicate financial conditions across the markets and banking system have loosened. Typically, when the Fed raises interest rates, financial conditions tighten. If easier financial conditions lead to a re-acceleration in economic activity, it's going to require us to do a lot more, according to Christopher Waller, a Fed governor. But the reality of the situation, Mr. Waller, is real simple. If inflation comes down, as gasoline prices are predicting they will, and is likely to do that, then the stock market's going to pull the economy up, at least hopefully is what you're betting for. And it doesn't matter if inflation ticks up a little bit. What matters is you get your soft landing, you can keep rates higher, and you can look like big heroes. Of course, that is, if demand doesn't come back, then you're going to look like a bunch of big zeros. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.